Well, good morning, good afternoon, good evening. We're really pleased to have the opportunity to present to you today. And it's certainly a great honor and privilege to be a monitor with these great panelists today. And to my left is Al Neer. He's the CEO, Hunter, which is an ESOP company that has went through some growth through not only private, but kind of say a few things about yourself.
Yeah, thanks, John. As John mentioned, I'm the CEO of Hossley Lighting and Power Solutions, based here in Dallas, Texas. We are a company that has been around for 46 years, but for 26 as an employee-owned company. We started in the 1970s. It was founded by Danny and Ann Hossley, who is the namesake of the company to this day. Danny ran the company, with continued success over the course of about 19 to 20 years, when he had made the decision that he was going to sell the company to the employees. So around 1997. He had engaged in an employee ownership transaction, and it did in fact sell the company, to the employee group. At that time, the employees took over. Danny sat on the board as a selling family member for several years after that. Then they brought in another CEO. At that time, it was not me. It was a gentleman by the name of George Palmer, and then George took the company, from the beginnings of the ESOP all the way up for about 13 years, to the next stage of its growth. And then George stepped down and I came into the company. Our company is a architectural lighting and controls company. It started originally just as a lighting manufacturer's rep, representing many of the premier brands in non-residential, commercial and institutional lighting. Over the years, it has grown in its presence in the Dallas-Fort Worth marketplace. When I came on as CEO in 2014, the industry had evolved significantly with the advent of solid state lighting, which you would know more commonly as LED lighting today. So it replaced traditional source lighting such as incandescent, fluorescent, HID, and with that, it came sort of a technology revolution, if you will. So, during my tenure, we have been on a very aggressive grow or die, type of a strategy. So as those of you who run technology business would understand, as technology continues to invade a relatively mature space, you need to be able to pivot and diversify your business. So one of the things that we embarked on, early in my tenure, was a geographic expansion strategy. At that time, the company was only doing business in the Dallas-Fort Worth metroplex. From there, we started seeking out like companies, to Hossley and other geographies. Starting first with Austin, Texas, then San Antonio. We expanded out to West Texas and Lubbock, then East Texas. This gave us a tremendous amount of scale in a hurry. But also, for those of you that deal with ESOPs, it created somewhat of a valuation conundrum, because we were growing so fast. At the same time, we were in the throes of trying to keep up with our repurchase liability obligations, in the fact that we were a mature ESOP. And so I'll never forget going to the various ESOP conferences, whether it's the ESOP Association, or et cetera. And I was wandering around these convention halls, and I'd hear all the great conversations about why you want to sell your family business to the employees. And then I would hear another set of stories of what are all the things that could go wrong, with respect to an ESOP. But I never heard anything about, okay, what what happens, as a second generation CEO of an ESOP, and it's because of a lot of times that just, doesn't happen. Is, I started to learn in this process that ESOPs have a beginning, a middle, and an end. And when we say an end, it's maybe an end to it being 100% as an ESOP. So what we started looking at were options relative to re-leveraging, recapitalizing the company. And initially we did that with senior debt, with traditional bank lending. And so that allowed us to take a lot of the mature, inactive participants that had retired, from the previous iterations of the ESOP, and we cashed them out, utilizing the debt, utilizing the debt. And at the same time, we kept continuing looking for strategic merger opportunities. And we embarked on a merger about 4 years ago with a company called Lighting and Power Solutions out of Little Rock, Arkansas. And so we merged that company into the existing business entity and created a new company that in essence was 60% employee owned and then 40% equity owned, by the partners. We still have the issues with growth and because as you grow and as you achieve more profitability, you also generate a higher valuation, which still gives you, the repurchase liability obligations that you still have to be mindful of. And so what we started learning is, okay, to prevent having a runaway valuation, if you will, from the employee ownership perspective, we needed to continue to grow, or else the company would find itself with a sustainability problem as we move forward. So senior debt, is still a good option, but I was introduced to the idea of, since we were a family owned business to begin with, we sold to the employees, and there's value in creating that culture of employee ownership. There's a value in keeping this going. There's a value in growing the business. But how do we continue to sustain that, again, without creating runaway valuations? And so the idea of bringing in another equity partner from a family office perspective really intrigues me, because that allows us to keep our culture, keep our core team, yet have people invested in the company to have similar interests to what we do.
Well, thank you, Al. And my other panelists, Colin, Patrick, why don't you say a few things about yourself and your history, and then we've got a couple of questions for you.
Wonderful. My name's Colin Patrick. I work for the Patterson Thoma family office, also here in Dallas, Texas. The family was founded doing private equity deals, right? They did leverage buyouts. So they would, in a more traditional private equity sense, they would buy majority control of a company and then try to grow the business. And then after several years, monetize. The founder of the family had that playbook of finding, good businesses, growing them, and then monetizing them on a strict timeline. In the inception of that, and I've been with the family for 11 years now. I help with not just private equity, we also do private debt and real estate, but private equity really is growing businesses, I would say, is probably a better way of, our passion is working with, motivated employees to successful outcomes.
Well, Colin, tell us how family office comes into play when you have 100% ESOP company, a 50% ESOP company, 30% ESOP company. Why it makes sense for a family office to even consider investing in that type of structure.
Sure. First, you have the seemingly perfect timeline horizon that's parallel with one another, right? So the ESOP needs to persist for a while. In the family office, of course, we have to invest for hopefully decades. And so we have that same instance of wanting to be with a good, strong company and being able to compound for long periods of time. If we were to sell something, then I have reinvestment risk, where I need to find another quality investment that hopefully can generate comparable returns that we were happy with. So it's really important to find that good relationship and that good business, the motivated employees that you can see in ESOP. So you already have that alignment, and that structure's in place, and they've been successful for long periods of time. And so to be able to kind of join a team that already has that infrastructure in place and could use our capital, right, whether to help solve some of the ESOP challenges or focus really on the growth of the business, whether that's organically adding, more talent or another factory, for example, certain businesses, or occasionally you could invest in adjacent industries that might be, not necessarily your core business, but, kind of along that continuum of maybe a potential subsidiary, for example.
Well, Al, I got a question. As you kind of walk through the Hossley story, which is a great story, very successful story, you've kind of changed your entity structure, and you've grown, you've paired up with other family businesses that continue to grow. And so when you sit in a boardroom, not only as a CEO, but as a chair, and you're thinking about the company, why would you consider partnering with a family office to continue to grow when you could probably just dial 1-800 senior debt and grow probably a little bit slower? But why would you consider that? You say,
Well, I think one of the big tenets is when you consider family business in its founding, family business that we merged with. It's introducing another family business. It's just a different, in this case, it's an investment partner, but it's still a family business. The motivations are still there. The interest in the business, presumably you wouldn't invest in a space that you weren't interested in. So if a family office is interested in our space, and there's a lot going on, within that, whether you look at it's just energy efficient lighting, you're getting into building automation controls, intelligent buildings, smart sensing, the opportunities for expansion and growth and even bolt-on acquisitions in that space, be it other companies or, as you mentioned, adjacent companies. The merger of electrical in a construction space to HVAC and the building automation, for the overall building envelope. There are companies like Hossley that are out there doing those various parts and pieces of the business today. Certainly we could go and get senior debt to finance our repurchase liabilities and give us some working capital, but then we're going to have the thumb down, from the bank from that point forward with the covenants in terms of what we can do and what we can't do. And, heaven forbid you're tied to the construction economy. So you have ups and downs, peaks and valleys in your business. You get in a down cycle after you just did a loan. The bank's got you pinned down and they got you by the throat. Now the company goes the opposite way. Now you're strangled and you can't potentially move. Whereas an investment partner in a family business takes more of a, hey, we know this happens. How do we get through it? Do you have additional resources, things that you can bring to bear that can help us through, turbulent times? And as much as all business leaders like to say, oh, that's never going to happen to me, it happens. And so it's a very attractive option for us to consider.
Yeah. Well, we've certainly had experiences with literally dozens of portfolio companies, and they face those challenges, whether it's construction risk, or interest rate risk, or commodity risk. So we think of ourselves not just as a financial resource, but just as a partner resource, right? I mean, we have our experiences, and if you're thinking about the HVAC or the distribution, we have, in this case, specific experience in those industries that aren't, the lighting industry per se, those tangential, things that might be of interest, where we can literally sit there and tell you exactly how we did something, whether we did it well or whether we learned a lot and lost a lot. That's still valuable to have, that sounding board. And you're right, as an equity partner, we're in this together, right? As opposed to a bank who has covenants, who's thinking about foreclosure. When you're in the same equity or some equity structure, with a partner, you're really aligned. And so that's helpful for us as well. It's more about the relationship. Of course, we want the investment to do well, but being in business with people that are willing to, work on this project together, fundamentally is what we like to do, just for business.
Well, Colin, I've got a question for you. And I think leading off of what you said and Al said about, so we hit a downturn and you're a good business partner. One of the questions I have, what is the difference between a family office and a private equity investor in a situation like this? And if you're in a downturn with the family office, that's looking for the long term, it appears to me you may want to take advantage of the market and make some acquisitions. Maybe it's a better thing. Maybe kind of walk through your thoughts on that.
Sure. The first one I mentioned already, the time horizon. Typically, private equity firms or funds have a finite life, right? They have an investment window of, say, it's 5 years, and they have a harvest period of 3 to 5 years. So generally, they begin thinking, hey, I've got 10 years to maximize something. At the same time, they might have the right amount of capital that they put into a deal. As a family office, we don't have those same constraints, right? I don't have a fixed timeline. Sometimes deals are 2-year deals, and sometimes they're 25-year deals. We're flexible. Whatever's best for the investment, you still have an aligned partner. We're all having fun. We're compounding our capital, and then we'll keep the party going. And second, to your other point, John, is there are times when it is time to double down or pile into your winners, or there's another add-on we can do. It's not uncommon for a private equity firm or a fund to have, again, finite capital, right? That maybe their fund, they're allowed to put $20 million into each of their ideas.
Right.
But we don't necessarily have that same stop. This is going well. Whether we bring the resources ourselves or we partner with other family offices, which is very common for us to do what they call a club deal. We can keep, adding to the deals that are working. So 2, I think, key differences, but you still have, again, the private equity expertise given our background. So we still know the senior lenders and the mezz lenders and, how to set up management compensation structures, the M&A activity, which is, what we fundamentally do. Without the constraints of time and capital.
Well, Colin, a question for you, when you say clubbing a deal to take advantage of some opportunities, big, small, down market opportunities. One question would come to mind is, do you stay in control of the transaction? Is the ESOP company's board just dealing with you, or now are they dealing with multiple family offices?
It's going to be deal specific. So also, unlike a fund, we don't necessarily have to have a majority control. Typically, a traditional leverage buyout shop is going to have majority control. They're going to control the board and ultimately the destiny. We don't have to own 51%. 40 might be fine. 20 might be enough. 10 might be the right number, depending on the deal. So I would say keep in mind the flexibility that we have at the beginning. When the company or we decide that it is time for more capital, whether we do it ourselves or bring our partner families in, sometimes they may have even more expertise in a certain area, right? Maybe we're adding capital to do a subsidiary in exactly the business that family made their money in. Well, yeah, maybe I do need to say, hey, these people may be in a better position to help manage this, right? And so maybe we add a board seat, maybe we trade board seats. I think the flexibility is a key thing to keep in mind. And the other families have obviously been successful through their own efforts to have their own family. And so their experiences might just be a perfect partner add, not just for cash, but for that business experience or industry expertise.
Well, that's a good point. I've got a question. Al, you kind of alluded to this. Colin, you kind of started going down this route. Is when you invest in an ESOP company, it seems to me there's 2 routes you can go, maybe 3. One is investing money into an ESOP company to solve their issue with cash and acquisitions, but the primary focus could be acquisitions of other companies in that industry vein.
Mm-hmm.
The second way, and I know we've talked a lot about this is investing pari passu with the ESOP company in a diverse group of portfolio companies that could result in clubbing, it could result in clubbing with other family offices, pairing with other family businesses. Maybe kind of walk through your thoughts on those two aspects.
So first I would start with obviously the board of the company. What is the ESOP trying to do? What are they doing well? And we always want to focus on the sources and the uses, right? So
Yeah.
the sources of funds would be senior lender, mezzanine lender, outside investment capital like ourselves. Got it. So that's the pile of things we have money to spend. And then on the uses, it is, what do we need to do? We need to service the ESOP liability. Are you trying to grow your core business? Are you trying to do, these adjacent subsidiaries? So, and if, as the investor, I can agree with the use of those funds, right? If, that's really the main thing, right? Is that key communication. And then that understanding the goals of the company would help us decide exactly how we did it. Do we invest directly into the operating business, the ESOP or the subs or the drop downs, or a pile of investment dollars? We can create a diverse pool of other investments that are maybe independent of the existing risks of the operating company. So wide open to ideas here.
A lot of flexibility, it sounds like. Well, Al, I've got a question about the board. And this is gonna flip over to Colin too, as you become business partners. When you look at your board today, you certainly had the combination of family business, other capital sources to come in to help grow the company. Your compensation or your composition of your board has changed from the ESOP company to what you are today. And kind of walk through, has that been a good change? Has it been good governance? Has it been?
I think it's been very good, good governance. One of the things as an ESOP board, absolute must. Is you need independent board members, and for those that are listening to this presentation that don't have that, I highly encourage you to have a majority or at least 50% outside board members at all times. It's just a good practice from a governance perspective being an ESOP. From a business perspective, the selection of those board members comes into, well, certainly with an ESOP, it helps that they have ESOP experience. That's good, but also we are looking at, do they have ESOP experience in businesses that are similar to what we do? We're going to go through the governance process of checking all the boxes. Are you doing ESOP the proper way? We might as well have good, business guidance, as well, when we're going through that process. And so as I look at, family office, while you might not know lighting and controls, do you understand our business? In the case of, Colin's firm, they do. So that becomes additive right out of the box. And so it's, it's not just, someone's got a board seat because they've got money invested in there. It's like, well, if we're in the boardroom and we're going to take that time to go through that process, then we want to value that. And we start to look at subsidiary businesses. We want valuable voices from those companies, to be in that boardroom as we don't just talk about, what are the governance issues of the quarter, but also what is the long range strategic plan of the business, and what is it that we're trying to accomplish, and what are the insights. And it's great when senior management can sit down and do, a SWOT analysis, but it's even better when your board can, kind of poke holes in it and go, here's what we see, and here's what we've experienced, outside of what your own management teams.
And Colin, when you invest in an ESOP company, whether it's to do acquisitions, to solve a problem, to help them buy a diverse portfolio group of companies, how would you envision your family office? Do you take control of the board? You mentioned you make 10% investments, you make 50% investments, you're very flexible. But from a board standpoint, how would you envision yourself setting and on the board or committees thereof?
first, we don't even have to be on the board, right? That said, you want that boardroom to be, right, that their job is to represent the stakeholders. Sometimes it's just the equity, sometimes there's, a strong banking partner, maybe you did an M&A transaction, there's a significant subsidiary that that voice should be heard. And I completely agree on the independent board members to really have that third or the second opinion, I guess, on how things are going, because I've seen a lot of boards, particularly when we first look at companies, where the CEO is surrounded by his friends, and it's just very much of a rah-rah room. And you can understand, as the ESOP has its own obligations, and a new investor is going to have its own plans for the business. The bank's going to have its own ideas of covenant compliance, and so being able to really balance those effectively, I think that usually that independent board member or members can kind of help keep everybody focused on, we're here to maximize for the entire stakeholder pool, right? Not just the current employees, current management, et cetera. So independent board members, strongly agree. Do I have to have a board job? No. Do I like them? And I would say, I want the people that are on the board to know the business, understand the challenges that are being faced, and also know those opportunities. And I'll be honest, I don't know everything about everything. So I'm not always the best board member, but I might have a good friend or maybe a co-investor, the club families that we invest with, where perhaps they have more talent in a particular industry that we can pair with our capital, and he can maybe be our representative for our equity. So it doesn't necessarily have to be a Patterson Thoma employee on the board. And second, I would say you can effectively have the control you want to see, whether it's an advisor or a board advisor or observer. But also, whenever you do a debt deal, you can have certain controls, like some negative covenants, like you're not going to have additional debt or additional equity issuances without clearing it to us. So you can still have, the influence that we would want. For example, if we only have 5% of a company, you don't want the 5% shareholder holding up, the room. We may have pre-agreed on certain terms that we want to have our opinion, respected in certain things. So boards, yes, no, just depends on the deal.
Well, question for Al, and then I've got another question for Colin. Let's say we have an investment and it's 40% family office, 10% family investor type, and the balance is still in the stock company with some management ownership. What type of reports do you give to your board and your investors now? And then, Colin, the flip question I have for you is, what type of information would you expect, and the timeliness of that information?
So we, every board, every management team is a little different how to do it. The way we go about this, we're transparent, in our board process. We do a full, quarterly financial review. We do an update, based on where we are on our forecasted plan, on our performance to our forecast plan. We look at, in our Q4 meetings, we do through our budget planning process for the following year, and we review that. So we go through the high level summary of the activities of management, throughout the course of the year. Probably every 18 months to 2 years, we'll review the long range strategic plan of the company and say, okay, how has that evolved? How has that changed? Because it always does. Your long range strategic plan is your living document, and of course it's going to change because the industry changes and the variables shift on you. We do review strategic challenges, on a quarterly basis, with our board of directors, and we're always, because of the ESOP component, we always talk about the repurchase liability component and where is the company relative to being able to fund its obligations as it relates to that repurchase liability. And then I think the last thing that changes as you have, whether it's personal equity, such as myself and the other business partners are now an equity partner from a family office, is okay, where is the company relative to meeting or exceeding the expectations of the equity groups that are involved in the company as well?
I would agree with the typical cadence, right? The quarterly meetings, the annual budget meeting, less frequent, but probably the most important, which is the strategic, what are we seeing here in the next few years? And then, of course, the ad hoc is probably the most important because those are the actual items right now. I was on a board last spring in Silicon Valley Bank, actually in this case it was Signature Bank, and it was like, hey, this is a Saturday phone call. You're still talking about it on Sunday. So that board role is active and needs to be very nimble. So again, the regular cadence, and then in case of emergency, break the glass, like it's time for the board to meet. So just being available for that.
I've got a question on expectations and resources. We're sitting in a board meeting. We just co-invested together, and all of a sudden, Colin, Al comes to you and says, we got the strategic plan. We're going to make a change to the strategic plan, but we're going to buy this particular portfolio company. And it's pretty clear that this management group is too lean to oversee it. It's also clear that we may need expertise to do the due diligence and if you're successful in buying it, to also oversee. So I got a question is, Al, what kind of resources do you expect Colin to bring? And Colin, what type of resources can you bring to satisfy that type of expectation?
Well, I think, we have to, it starts with a look in the mirror and an honest self-assessment of what do we have. And in smaller businesses, and obviously understanding that in the company that I run, we went from being a smaller business to a much larger business, with designs on becoming larger, and larger and profitable. So no one person in the management team is going to possess all the knowledge, and even as we've built the company, there are gaps in that knowledge, and so I would look for a thought partner in that process that says, okay, we're going to take on this venture, whether it's an acquisition, do we feel confident in the existing management structure of the target buy, and if we don't, do we know someone or have the wherewithal to be able to bring in a strategic, leader for that subsidiary? Leveraging your network, through your relationships. That would be the kinds of things that I want to sit down and identify, and then be able to talk through how do we do this before we go bite that off. And if it doesn't have a strong probability of being a successful deal, then it may become a walkaway thing because the expertise isn't there. It might be ideal to pick that up, but if we can't lead it and we can't run it, and if we're just going to dilute the management team that we have, it becomes more of a distraction than an asset.
Fair. I would say, as an investor in, if when we were, to engage with a company, M&A is literally our strong suit. Lighting, we do deals. So being able to bring those resources, like we know the Q&B firms, we know how to get through the technology diligence, get through the platforms and understand, does this tech work? Are the patents protected? Like that's literally what we do. And so that is often, just like I'm on the audit committee as a CPA, generally on a board, I would say as a board member, what we bring to a business in this situation would be that how do we execute our growth strategy, right? So whether it's subsidiary or organic things, M&A would absolutely be where we would be helpful. We would like to be very active in that role.
Well, as we close out our session today, I've got one final question and maybe two. When you start going down this path together, because we started the day as 100% on ESOP, we did a transaction for growth capital, so we became a 60-40 for example, company. And now we brought in more capital to make some acquisitions, both on a vertical basis and then also on a horizontal basis with some diversification. What's the downside? And Alan asked you first, what's the downside bringing in a partner going this direction? And then Colin, I'm going to ask you, what's the downside from an investor going this route?
Well, I think the downside is you don't do the effective level of culture management within all of the entities that are coming together in this partnership. It's one thing for, us to have a relationship, as partners, but what does the chemistry look like with the other equity partners? What is the chemistry with the board? If there's issues right away, we need to address them head on in the beginning, and fundamentally no different than any kind of straight up, M&A activity between the culture of two companies that are coming together. I think the biggest downside risk that comes out of that is not managing that expectation, right out of the gate. And then everybody's left 6 months into a partnership feeling like it was a bad idea. We don't, that's the ultimate downside to me, is people have legitimate buyer's remorse, because they're in it now. Okay, what do we do with it?
They're certainly hard to get into the deal, sometimes even harder to get out.
Yeah.
And so you're absolutely right as far as managing expectations. Certain investments we make, we're focused on cash flow and yield. And if I invest in this firm and I'm expecting a 15% annual dividend and I'm getting 5 or 0, we're probably gonna need to chat about it. If I know going in, we're gonna have a big growth plan, we're injecting capital into the company, and then all of a sudden the management team declares bonuses for all the employees. And it's like, hey guys, we had this capital to go in to, do this other thing, right? Back to that sources and uses we were talking about. Like, this is what the use of funds is. And so expectations is totally right. Over time, of course, certain things can change, right? The liability of the ESOP, may or may not be managed well. We can help with that, or, there's so many certain situations where I think the going in expectations, fast forward, 10 years or 15 years, and we just have to look at ourselves and say, are we both still having fun? Are we doing it profitably? Are our reputations intact? Do you want the family business to keep their good name? It's a family office, our name's on the door. We want to keep a good business reputation in the community for our other relationships. And so there is that constant evaluation, but usually good communication, consistent, good reporting, the transparency, you can kind of stay on the right road. And in worst case, I would say, think about that end in the beginning, which is have provisions in your documents, for example, like a buy-sell agreement. And it can be even something hard coded, say, hey, in 10 years, let's take a look at this. And then there maybe a put, call, or your attorneys can help you with a lot of these different structures, tag and drag provisions. There's all kinds of things you can actually put into the documents that in 10 years, you might wish you put them in there. So when those documents get really long, there might be a page or two that you're going to be happy is in there a couple years later. So.
Well, I want to thank you today for participating in this panel. And hopefully what you've learned today is we started today with 100% ESOP company that needed to grow. And hopefully you've learned that there are some alternative capital sources other than just senior banks and mezz lending. There's not only private equity, but there's also a family office that shares the same values as an ESOP company from a culture standpoint, from a long-term investment standpoint, because some of these investments not only go on for 10 years, some of them go for 20 years. They could go longer. And that's one of the things that I hope that was one of the takeaways for today. The second one is probably very important here, is that the employee ownership continues on in some form. It could be an ESOP that started the day at 100%, but ends the day at 20%, but it continues on. And there's other options out there for employee ownerships as more transactions are taking place. Stock options, stock appreciation rights, profits interest, all kinds of different techniques that can be used to continue to propel the company forward. Thank you for your time today. We appreciate the opportunity to speak with you this afternoon. Thank you.
Thank you.